Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, September 21st, 2022. It's 4:01 Eastern Time, so the market's just closed. I couldn't wait to get this one out to you. I started to work it up earlier, and then I realized, by the time I record these things, get them, they got to run. They have to process first on my computer, then they upload to YouTube, and then they process it on their servers. And I realized I would not be able to get it out before the close. So I'm going to show you, as I promised, I'd do an update today, and that's what I'm doing now. I'm going to show you my thoughts. And of course, as always, these things can change. But here's what happened. Let me just recap for those of you, I know a lot of you don't trade full time, so you're not in front of the computer. But here's what we had today when the FOMC announcement came out. So you can see on this 1-minute chart, this is 2 p.m. right here. These are 15-minute hash lines. 3 p.m. right there, and there's a close right now. We just closed. This, to me, what I saw today, and believe me, I always expect, especially in a big Fed meeting like today, I expect volatility, and I talk about this. I say it very often. The initial reaction is usually faded, and even then, quite often, the subsequent reaction's faded. So I just want to show you the magnitude of these moves and tell you that it is just 110% signature bear market action. You always get post FOMC volatility, but only during bear markets when volatility is higher than in bull markets do you get these swings. So we immediately dropped in a matter of just minutes. Each of these bars is 1 candle, 1 minute. Each of these candlesticks, 1 minute. We dropped immediately following the FOMC announcement 2.41%. They faded that to the tune of a rally that was a 3.19%. So that's where I got out that bounce trade idea for you. Then they turned around from there, which hit resistance, a drop of, well, by the close of 3.58%. Wow. That's, and believe me, remember, we're not looking at an individual stock here. You're looking at an index, a basket of 100 different companies, the largest companies in the NASDAQ composite, multi-billion and even trillion-dollar companies. So that shows you what kind of volatility. There was more buying, I'll say that, on the upside than there was on the downside, at least, in that initial surge. But let me show you where we finished the day, and I'm going to give you my thoughts. Let me just flip over to this chart. I'll talk on this in a second. I'm just going to cover the index. Well, no, I'm going to cover the indexes and bonds in this one, because that's most relevant to what I saw. So I watched Powell's conference, at least most of it, and I'll tell you my thoughts is, well, you've heard my thoughts on Powell before. I think what he's did to put us to where we're at, I use the word criminal neglect. I think his negligence was so blatant in knowing, anybody in his position should know better that he kept the rates way too low for way too long. But whatever. At best case, it's gross negligence, and anybody worked for any corporation, a CEO, would have been fired 100 times over. And so, of course, there's no accountability there. And now, when I watch today, I expect at least, he talked the tough talk at Jackson Hole because we didn't have a Fed meeting last month, but he actually surprised me how gung-ho he is, and headstrong to continue, the talks. And again, it's all rhetoric. I know that's one thing. The Fed, they talked about another 150 basis points still to come, and that's the current dot plot, if you will. And I know, and that the Fed is reactive, not proactive. But right now, again, based on the economic indicators that have just started to turn, and I get that he's acknowledging that, but what he's not acknowledging is interest rates, for example, going from more than doubling in very short order. Housing market isn't going to have a slow roll. It's going to have a hard crash if this trend continues. So he didn't acknowledge him. What I was expecting to hear is some type of walk back on quantitative tightening. They didn't talk really much on that. I might have missed something. I heard one question about the mortgage MBS part of it. That's the mortgage-backed securities, where one reporter mentioned, how interest rates went up above 6%, and but his answer on that, and again, that wasn't specific to Treasuries. It was the mortgage-backed bonds. But he was emphatic that there is not even discussion or any thoughts at this point in time of backing off that. So net, that's not good. And again, I didn't hear anything specifically on treasuries, and I'm going to talk on treasuries in a second. And that actually worked out good for me, doubling down on that initial drop. And I've sold all the short term, the ZF, the 5-year, and I'm going to sit tight on the 30 and 10s for now, and I'm going to show you that in just a second. But what happened is, again, you can see the fade, and the trade to be made today was at the lows. That was that initial plunge. This is the chart I got out to you right away, right after the drop, and said you can go long here. Showed you the breaks where the resistance levels are, and so that's it. We popped up, and that was that the biggest rip of the day, or the second biggest. It was the first biggest and second biggest, and then even third was even bigger. That's third and final reversal. But we pretty much came up for a back test of that trend line, and let me show you what we did. This again, or that was the 60-minute chart posted earlier. I'm going to zoom in on this one a little bit for you so we can tighten up here and show you exactly what happened. So in doing so, there was our, the entry this afternoon, right after the FOMC meeting. It's hard to see. It's such a skinny candle, but there's a long white candlestick shadow right there from the body down. That's where we popped it. We went right up to that past the 1290, because remember, we've already tested it several times. Popped it on a momentum fueled overshoot, and then came up to back test that trend line from below. That was the second arrow break, and in doing so, at that point, we put in a divergent high on the 60-minute chart. Then the selling programs kicked in hard, and after listening to Powell, and again, I know that the Fed will 100%, as they've always done. They'll pull a 180 at some point. But I have to say, I was a little surprised how hawkish he spoke today, unwaveringly hawkish, and he even made some comment in there that about when we talk to people and they tell us, those that live paycheck to paycheck, how tough it is, and those people can't. And it's true. If you're living paycheck to paycheck and you have zero disposable income, you cannot tolerate these hikes in food prices. But he turned around, and on the same breath, he's saying that he expect pain. And somebody asked, well, what does that mean, define pain? And he talked about job losses, economic contraction. I mean, I'm sure some of you read the headlines, maybe some more than others. Just the other day was a Gap, 500 jobs cut at Gap. Facebook today announced that they're cutting jobs. Goldman Sachs, all the big companies, FedEx. We're seeing, to me, a very rapid turn. Something that's been completely priced in the charts for a long time. So this is my long-term view. Has not only not changed, it's been reaffirmed just lately. There's been an acceleration. That's what I look at, trends, and you can kind of get in front of the early trends. So where I'm going with this is, it is absolutely ridiculous to say, okay, you're Joe blue collar, right? And you have very little margin of room to cut to tolerate higher food prices. I mean, yeah, you can drop the cell phone plan, you can drop the NFL package on your satellite TV. There's room for that group, for generally speaking, to. But what's worse? A 50-cent a gallon increase on milk, a gallon of milk, or losing your job? So he's outright saying that he's going to cause pain, keep these rates, keep the pedal to the metal, because he's so hell-bent on stopping inflation. In other words, he thinks that a rise in prices is the lesser of two evils compared to job losses. Let me tell you, as tough as it might be for that middle class, because they're the ones that work for Gap and for FedEx and all that. And so when the economy rolls over and we see massive job losses, which again, it's only just starting right now, that to me is infinitely worse than a bump up in prices. Not having a paycheck, to me, is a lot worse than having a paycheck and having to deal with higher prices. Okay, so enough of my rant. Anywho, so that's it. Like I said, today, just based on that, if I'm going to take one data point out of this, I'm going to say today was pretty bearish because of that. He didn't leave any room. He didn't mention backing off the quantitative tightening. Now, On the flip side, I always say this, it's better to be lucky than smart. So that played out well on the 30-year, and I still think we're going to see that. And that's why what I did is, I told you earlier today in the first video, here we'll go to 1-minute chart here for the ZB. There was a big surge in a big drop in bond prices. Bond prices right before. Did I go back far enough here? Let me go back to 2-minute chart. 2-minute candles. I'm talking. Okay, this is ZB. 2 o'clock is right here. So you have. Oh, sorry, I had to take an important phone call there. All right, so there was a drop, and so as I told you earlier, that was a buying up. Went into the day with positions, added up pretty heavy on the bonds. For reasons I stated, and again, most importantly, and I always have to say this, most importantly, the technicals. I'll never ever go heavy on a position or really into a position on a hunch. Sometimes into one, but the charts always have to confirm for me. And so that was a great buying op, and boom, big move up in treasuries. But you can see now, why is that? Okay, well, let's say Powell continues and the Fed continues on their path, and they're going to they're going to tank the economy, I should say, in order to kill the beast that they think is the greater of two evils, inflation. Well, what that's going to do from a fundamental perspective is bring down long-term interest rates, because if you drop the economy, number one, in a vacuum, this is how bond traders operate. If they think economic growth is going to go down, therefore longer-term bond rates, and it's going to affect the longer end more than the shorter end, you're going to have, and especially because he's bringing the shorter end up. So ZF is the 5-year bond. I sold those even though there was a pop. I don't expect any outperformance there. I expect the long bond to outperform, because now economic growth, as long as the Fed is hell-bent on fighting inflation, even at the risk of the economy, that is bullish for bonds, bearish for bond rates. Remember, the rates and the bond prices go inverse. And so I think that's why we saw this pretty good lift, and we saw the long bond hold the rally, the post-Fed rally, versus the stock market, which saw it get faded for that reason. Okay, stock market does not want to see falling economic growth. Long-term treasuries do. And then the other component to bonds is inflation. So bond traders, it's a double whammy. It's two positives today for the long bond. The 30-year bond is slower economic growth, which means lower interest rates, as well as the Fed being successful on fighting inflation. And because Powell pretty much said he will not stop until he has killed that beast. And so therefore, bond prices or yields are also based on future inflation expectations, because inflation higher inflation, higher interest rates, lower inflation. So therefore, and there's a little work to be done, but I just wanted to reiterate, I'm still bullish and sitting tight on a pretty chunky position of long-term bonds. This is let me show you the 60-minute chart I showed you earlier. We have to break out of the downtrend line or the price channel, and there it is. We closed right on it. There's the highs right there in early August, the beginning of August on ZB, and we're right there. We rallied up to the channel. We haven't broken out, and this is kind of my BOD level. I told you earlier I set a price alert at 131.70. If that triggers, then I'll know we have taken out the trend line and a little bit of minor price resistance, and then you can see I have another minor level at about 132. But I think this is a potentially explosive setup here relative to bonds. Again, explosive is not going to move like natural gas or lumber or even the NASDAQ 100. But if you can get a 3-4% rally up to that first target zone right there, about 4% or so, that'd be a nice move in treasuries. And again, fundamentally and technically, the case can be made. I just made it. So, but at the end of the day, like everything else, I'm either going to be right or wrong on this one. So it's not, my only position, nor would I put all my eggs in one basket. The stock market, like I said, I thought we might see a decent rally, and we still can. I'm going to go back to that and then wrap the video up, because that's what I wanted to focus on here. So we go back to NQ, 60-minute chart. This is what we're looking at. You can see here, DL means divergent low. That was that divergent low. There was our rally, the divergent high. This was all the post-Fed pop, rip, dip, and subsequent rip, or subsequent dip, that is. We ripped up, ripped down. No, we ripped down, we ripped up, and then we ripped down. Yeah, it's been quite a day. And we closed and we took out these lows. That's not good, number one. That was support. Let me look at it on QQQ and SPY and show you what I'm looking at here. So on QQQ, we had, as I said, there was no good support, or there wasn't any good support on the QQQ weekly or daily chart. This was only positive divergence on the 60-minute time frame. We had a little trading range recently, but that's now been taken out. So to me, that was a sell signal, and that's why I'm going to go home short tonight, and I'm going to stay short because we could be on the cusp of that big drop down now. If we snap back up in there, let me say this, these positive divergences are still in place. Remember, as an active trader, we already hit that quick, we hit that second target. You weren't going to go straight up. That's why those arrow breaks. We had the reaction where I thought we would, and I even on the pullback after selling the NQs, recycled back into that trade, but then got stopped out. So that was the there was the first 1291 right there, then the uptrend line. We had a reaction, but I would have figured it if we were going a lot higher. About right here, and here is where they should have bought, and worst case, this is where I started going back in, and then I got stopped out under that. That was a nice uptrend line. Remember this morning we had that triangle pattern? Boom. When that gave way, that was it. Then they went on and right on through the previous lows. So let me make it very clear. As of now, until and unless 11,785 is taken back with conviction, that would be the minimum thing. And if that happens, then there's still a chance because we can turn around here. Still a chance for a bigger rally. We can confirm these big positive, aka bullish divergences, but we need to do that. Then they need to also regain that triangle pattern right there. They need to get back above that. And then, of course, they need to pop 1290 again with conviction. We've had multiple shorting ops there, reversals, including today, or chances to get out of longs. We need to break that. So bulls win over this, and they'll take us up to that next level, possibly the downtrend line. As of now, as of this moment, based on the impulsive nature, and again, I try not to read too much into a Fed day, but that was pretty powerful selling in the fact the buyers were MIA at any of these support levels, coupled with what Powell said, puts me back in the near term, and I've never wavered away from the longer term bearish camp, but in near term, intermediate term bearish. And again, that can change by tomorrow. If the futures do this overnight, I'll be stopped out of these shorts, and I'll have layered stops. It'll scale me possibly. It depends how high. I'm going to set all my stops tonight after we close here, and they may scale me not only out of those shorts but back into longs. Although I probably, if it's going to happen overnight, I want to take a look at the charts a little. You got to be a little skeptical of the overnight moves in the future, especially 2-3 in the morning when everyone in the U.S. is asleep and it's just they're kind of trading on autopilot there. Let me show you the S&P 500 because the Nasdaq's not everything. See, here's the 60-minute chart, and remember, I'm zoomed in up close. This is what it looks like on a 3-month. So you really don't have, these are our previous lows way down here, and it looks like you're heading towards them now. And the fact they've already been visited and that was a major target, I think we'll just, if we get there, if these divergences are burned through, we may just keep on going. But as of now, let me zoom back in a little tighter so you can see it better in the video. This is what we had recently for last week. We had these divergences building, and we've started to rally. And of course, we weren't going to go too far in front of the Fed. We hit that 39.36 target that was given. That would have been the next target if that was taken out. But they never, they failed to even get there today in SPY, and they took out pretty impulsively the previous lows. This was our recent trading range right here. Let me box it for you. And as I told you in today's previous video, the winner of this, wins the direction, gets to pick the direction of the next trend, bulls or bears. And right now, bears. Again, it's a Fed day. Maybe it's a whipsaw. Maybe it's an overreaction. And so we'll know. If we re-enter this trading range, just like on QQQ and NQ, if we take back the lows, we'll probably sail on up back to the top of the range. And at that point, especially if these divergences are still in place, maybe we get the breakout. maybe, you're probably not going to hear any 180 from the Fed the day after the announcement. So we'll see what happens there. But going forward, I do think as soon as the rest of the Fed mouthpieces start, doing their little, their meetings and they speak here and there, the different Fed members, you'll see some of them start to backpedal soon, especially if the economy continues down at the rate that it is. Things are turning pretty quickly, I think, and a lot quicker than the lagging indicators and what the Fed's looking at tells us. So that's it. In a nutshell, divergences are still intact, but we broke some pretty decent support. Those lows we've been trading at recently, and unless those are recovered, there's a good chance we're going lower. And remember, I've said this, I may not have repeated it today, but I've been talking about it recently, in recent weeks and months. I'm going to jump to a longer term chart. There's that period on SPY on the 60-minute chart. There's what we did today. That's a solid breakdown. That's what I call a solid 60-minute close below. Not the white candle, that's the after-hour session, this red candle. And again, take it with a little bit of a grain of salt because it happened immediately on the heels of an FOMC meeting. But as of now, since it was so far below the 381 support level, I'm going to have to take it for what it is. And again, if it changes, then I'll change. But this is where we're at, bigger picture. This is a SPY on the weekly chart. Since we got rejected off the 200-day moving average, that's on this weekly chart. It's the yellow lines, the 40-week moving average, same thing. Got rejected there, sent us down, got rejected again, and it's been nothing but impulsive selling. This is QQQ. We had 1 week of buying right there. But so far since the rejection, 1, 2, 3, 4. This week's not over. We're only halfway there, but so far 5 out of 6 weeks of 6 candles are red, and that is indicative of bear market action. So there is that potential. It's always been there, even with the, in the last few days we had those 60-minute divergences. That potential's never gone away. That we could be in that really about halfway down through that next final leg down to that fourth target there, 235. And like I said, look at this. I don't see any support here, but sometimes you can have the markets reverse above support in what I call no man's land between support and resistance. We'll just have to watch those short-term charts to find out. So that's it. So ending the day, back to short equities, long Treasury bonds, preferring the longer end of the yield curve over the shorter end of the yield curve. This has been Randy Finney with Right Side of the Chart. Have a great day.